Hi guys, welcome to today's webinar series, which is in partnership with our sponsor broker, Ingot African Limited. Today we are going to be discussing more on risk management and technical analysis, with our guest speaker being Akil Stokes. Tune in and enjoy.
Hi, thank you for joining us. You can mute your mic as we wait for Akil Stokes and other guys to join. Thank you.
How you doing? Finally able to get in.
Sorry about that. Yeah, but you're good?
I'm good. Yeah, yep.
All right, we're also good. I think we last spoke to you earlier on in the year. How has it been for you, 2023?
It's been good. It's been too fast. I'll tell you what. It's crazy that we're in December. We're a few weeks away from a new year, and it seems like it just started and it's way too fast. But I guess that means you're enjoying yourself and you're having fun when that happens.
Yeah, busy also is good. Time flies.
Yes. Yep. I agree.
Yeah, so today we'll just do like 30 minutes of like your live trade setups, more of your trading strategy, more of what you would prep for your trading chat room.
Okay.
And then we take like a Q&A from, I'll admit guys as we go because of time limitation. And then we get it done. And this is actually the last webinar for us for the year.
Nice.
So it's truly an honor to have you back on the lounge.
Appreciate it. You get a little bit of a break at all, or?
Yeah, we will be breaking next week and then back to work in Jan. So
okay.
Yeah. All right. I think because we've interviewed you in the past, we don't need to go through your bio again. We can just start with a quote from one of the traders who also shares in your trading strategy, which is purely based on technical analysis and price action. And she tells beginning traders, even seasoned traders, that the best education they can get is by observing the charts. That's Raggy Horner, if you've heard of her. So maybe you can just touch a little bit on that. And then I've given you access to screen share. We can go through your most recent trades, a winning trade, a losing trade, as long as you're using the same strategy, which I suppose you haven't changed in a bit.
No, yeah, I can show some examples of things that are on the radar.
Yeah.
Yeah. So, for me, I'm a price action based trader. I believe in technical analysis. I come from a fundamental analysis background, so I have experience doing both. And although going from fundamentals to technical seemed crazy at the time, it's the approach that makes the most sense. I believe that the markets or a price chart is nothing more than a visual representation of everything that's happening in the markets and all of the market's participants' actions. And that if we truly want to understand the market and how it thinks, how it breathes, we can see all of that information on the chart. As human beings, we're pretty predictable over time with our buying and selling habits, with why we buy, why we sell, greed and fear, all of that stuff. And because of that, we see some pretty predictable patterns on the price chart as well. And if you're someone that can, you have the skill to analyze the market and pick out those predictable patterns, you can execute them with high probabilities. Easier said than done, obviously. I like to think of it as like a needle in a haystack, or like a magic show, where there are these particular setups that over time have been proven to work. Not all the time, but with the probabilities in your favor. The problem is the market kind of gives you a million other things to bait you, to distract you, to kind of, get you off the trail. And unfortunately, most traders, including myself for a very long time, fall victim to that, whether it's, over trading or not being patient, or going off of my feeling, or seeing the correct setup, but being afraid to get involved, or staying in it too long, or getting out of it too early. One of the handful of many mistakes are out there. But from a analytical perspective, I don't think there's anything better than the price chart. And even if you are into fundamental analysis, the price chart can be a massive help on that side of things as well.
All right. And then maybe just to touch on your trading strategy, for an intraday trader, I think your holding time frame is usually 4 hours and below, like starting from the higher time frame and going backwards. So maybe you can just touch on also your strategy as you analyze. Maybe we can take an example of major pairs that you're looking at recently, and then we go from there.
Yeah, sure. So I work on pretty much from the daily to the 1 hour time frame. So I'll use the daily as my higher time frame to kind of get a bird's eye view, gain perspective of the land, see what's happening without the distraction of needing to trade. Then I'll work down to the 4 hour and the hourly for the execution of my trade. So getting kind of a zoomed in view of what's happening, seeing a little bit more of the details and looking for those small clues in the market to execute my setups. I'm a price action trader. If I had to sum it up very kind of remedially, everything that I do is centered around support and resistance. So support and resistance, supply, demand, structures, I like to call it. Harmonic pattern formation, whether it's a classic pattern formation, whether it's trend continuation, whether it's counter trend, in some way, whether it's an entry or an exit, it's all centered around structures. That is pretty much the backbone of my trading philosophy. I believe it's that powerful.
Yeah. And then you also do a lot of pullbacks and trading breakouts as well.
Yep.
All right, cool. So then we do the visual aid, and then you can take us through your most recent trade setups.
Sure. Let me get this over here. I can show you something that on my radar this morning. Where is it at? Here we go. Let me know if you guys are seeing it.
Yeah, cool.
All right. So we'll just go down to the euro dollar real quick. And the euro dollar is a pair that's had a lot of activity this week. We had an FOMC statement on, what was it, Wednesday, where for the first time, they've been hinting at this for a while, but for the first time, they pretty much came and said, hey, the rate hiking cycle here in the US is pretty much over, and we're gonna start cutting rates in 2024. And because of that, you saw a big reaction on the dollar pairs, you saw a big reaction on the yen pairs as well. And you can see over the last few days, we've had a massive movement to the upside. So what I'm looking for is a few things here. Again, I mentioned everything in my trading strategy is centered around structure. So when I look at my higher time frame, the first thing I'm asking myself is, where is price trading at? What has price recently done? And where is it at relative to structure? So what has price recently done? Well, we've recently worked up from what's called a falling channel, or a rising channel, excuse me. We had a fall from a rising channel where price action rallied up into a previous level of structure if we look left, and then we saw some relief to the downside. Price action, after getting the news, rallied up again, and currently we're trading at a retest of the structure high here. So if I just take my box right here and look at this previous level of structure, we've come up to that level. We have a nice psychological number as well with the 110 even handle, and psychological numbers are numbers that us humans are very comfortable with. So anything that ends in 0050, it's like, these are numbers that are easy for us to multiply, easy for us to divide. It's very common that you'll see these psychological numbers be key levels of interest in the market. So what we're at right here is called a decision point. We're at a previous level of structure resistance, and either one of two things are going to happen. We are going to violate this level, or we are going to hold this level. And I kind of look at my trading as kind of running these if-then processes in my mind of, hey, there are two different scenarios here, which can happen, right? So we can have one where we violate, which would mean a break and close above, and we would have one where we hold. And if we violate, then I would expect a continued move to the upside. And that's when I would look for some type of breakout or some type of pullback trade to get on that continued move to the upside, looking for our next level of structure to the upside. If we hold, then I'm looking for some relief. So I'm looking for a move to the downside. So a lot of traders come into the chart and they get confused on, should I be buying? Should I be selling? Should I be bullish? Should I be bearish? What do I do? And there's no rhyme or reason. And what I want to do in my process, and I call it the IPD, decide, execute. I want to go through a process that allows the market to do the thinking for me. I don't want to think about, should I be a buyer or a seller based off of feel or what I think the market's going to do. I literally want to look at the clues that the market is giving me on the price chart and make my decision based on this. So let's just go with the hold right now, because currently we are holding. So right now, price is holding at a previous level of structure. So the only thing I'm looking at is the potential short, right? If we end up violating, breaking, and closing to the upside, then I'll switch and go to the upside. But right now, the only thing I'm looking at is potential shorts. So as I go down to my lower time frame, which would be a 4-hour or a 1 hour, now I'm asking myself, well, what can I do to get a short? We can see that price action already rallied up into that previous level of structure, that psychological number over here, the 110 even handle. The RSI, which is my indicator of choice, the relative strength index, has gone massively overbought as well. Now, this thing was overbought from really right around here at 108.96, and we stayed overbought all the way to the highs. Now, overbought in its own right doesn't mean that price has to reverse. Obviously, we went overbought all the way down here and we kept going up, but the relative strength index does tell us how much strength is in the market. So, ideally when it's going up, it's stronger. When it's going down, it's weaker. The thing is, things don't stay strong forever. Things don't stay weak forever. So I kind of picture it like throwing any type of ball into the air. If you throw a ball into the air, it's going to come out of your hand with a lot of momentum. It's going to go higher and higher and higher, and eventually it's going to reach its kind of peak point. It's going to slow down and start coming back, and that's what we're looking for here in the market. Where has strength reached its peak point, and eventually some relief has to happen. So the next question is, how can I take advantage of this? And well, this is where we can use, there's multiple reasons for entry that you can use, but if we're going to speak of, let's say, a simple and classic pattern formation, one that I would look for here is going to be called a double top. So you can see price action came up to our previous level of structure and started to reverse. Well, this is going to be our first top, right? We then got a little bit of a retracement off of that. If we were to come back up and retest that level, we would have to hold and not violate. That would be a second test of this level of structure. If we get another hold, that's a good sign that we may see a bearish movement or bearish reaction off of this level versus a break. And this would be a classic pattern formation called a double top. Now, ideally, I'd love to team that with something called RSI divergence as well, meaning that we have, let's say, equal highs here on our price chart, but we have lower highs here on the RSI. I don't know if that's going to happen or not. We'll have to wait until if the pattern actually occurs, but that's something that you can pair with it as well. And then this would be a good entry for a sell. Now, there's 3 steps of a trade that we got to go through. We have to go through the entries, the stops, and the targets. So after we do all of our analysis, then it becomes entries, stops, and targets. Well, entries are going to be the double top. So that's one that's taken care of. Now, the next thing I want to do is my stop. And my stop and my targets combined are what's going to give me my risk profile. This is the risk management thing we talked about. So for me personally, I like to have my stops above the pattern formation. I like to have my stops above the level of structure. This structure is the decision point for me. So to have stops not above it just wouldn't be safe. I think one of the big problems I see a lot of traders make is, well, one, they have stops too close because they're afraid of risking money. 2, they have stops too far because they're afraid that their stop is going to get hit and they want it really, really far away. And then 3 is that they just don't have any rhyme or reason for why they're placing stops. They're putting it at random locations. Put at an area where the market, or a price point where the market tells you that you're most likely wrong. So it should be based on your analysis. Where is the market going to tell me that I'm wrong? And then obviously within that wrong period, you want to, you want to be as close as possible. You don't need to waste a million pips to know that you're wrong. If you can know you're wrong before you're a million pips in the hole, that's going to be a benefit. But you don't want it super tight because you also want to have, you want to give market the room to breathe. So for me, I base my stop losses off of an ATR, an average true range. It's a like a volatility index for the market. It tells us how much the market has been moving over a blank period of time. So if I go to my side deal right here, hold on one second. I always have to change this thing around on me all the time. There we go. you'll see that if I look at my most recent candle and I look on the right side of my deal, my ATR is going to say 36. So what I want to do is I want to get between 1 and 2 ATRs above the highs here. So if the high is right here at 110.08, I want to do 110.08 plus 36, which is going to be 38.44. And that's where my stop loss is going to be. Hopefully the math is right there, but it'll be 44. Right in here. And I ask myself, does this give me the safety I need? Is it above my entry pattern? Yes. Is it above previous structure? Yes. Now I do have the option to kind of double that and make it bigger. So put it maybe up here somewhere. But then again, that question is, do I need to have a stop loss this high to know I'm wrong? And the answer is no. I'm gonna know I'm wrong right here. So there's no need to waste any extra pips. The next thing I want to do is I want to ask myself, okay, I have my entry, I have my stop. Where is my target? Where is price action likely to go to? And this is where more analysis is going to take place. So I'm not basing my target off of just a random number. I'm not basing it off of a set risk reward. There's plenty of ways to do it. For me, it's based off price action. And I want to ask myself, where is price likely to go? So I can use a few tools, right? I can use my Fibonacci retracement and bring it in from a swing low to swing high. I can see if there's any Fibonacci levels. 382 is a normal type of retracement. That's sitting right at an even handled number as well. Again, a psychological number, 109.00. I can also bring in what's called a volume profile. And a volume profile is going to tell me essentially where the interest is at in the market. So the bigger you see these spikes on the right-hand side, the more interest there is. So if I'm looking at areas right here, this is an area where there is interest. Obviously, we're fighting and battling right there right now. This is an area of interest right here. Works perfectly. That's right near my 382 and my psychological number as well. So those are kind of three clues in the same space. I want to jot that down in my head. And then the most amount of interest is right down here at the lows, which is no surprise because this is where we see the start of our move and a big level of consolidation. So if I'm looking for target areas, right, a good area for me is going to be right here, number one. And if I'm looking for a secondary target or if I'm more risky, right here would be number two. So I'll put a little line out there as well and measure it. And now I'll see what the risk reward is like. So for me personally, I need a minimum of a 1-to-1 risk reward. So a little trick that I'll do is I'll take my Fibonacci retracement tool once again, and I'll drag it from my stop loss, my projected stop loss, to my projected target. And I know that 50% is going to be right in the middle. So in order to have a 1-to-1 risk profile, I need an entry on this double top that occurs above this level. And that should be no problem. In most cases, the double top is going to form somewhere up here. So I know that I'm probably going to have a risk profile. And again, we won't notice until we actually kind of complete this thing. But most likely, I'm going to have a risk profile that looks like this. It's much greater than my 1-to-1, so it meets those rules. And then now I wait. Now we sit back and we wait and we see if price actually gives us the confirmed double top. If it does, I take the trade. If it doesn't, then I look for the next opportunity.
All right.
So that's a good example of a structure-based counter trend trading scenario if we hold this level.
All right. And do you make use of any indicators for your visual aid?
Aside, the RSI is really the only one that I use. I'll use Fibonacci's, I'll use volume. I look at those more as tools, but the really the only indicator I'll use is the relative strength index. I guess technically the ATR as well, but I don't really need it. I just need it to kind of know the number of what the movement looks like. So the RSI I use a lot, oversold, overbought, divergences. There's some funny other tricks you can use with different zones of strength as well. But I tend to only stick to that single indicator.
All right. Do you have another example because I think this the first one, I think it's more on a bearish pattern for this currency pair. Bullish, that is. So we can do like an example on a bearish one.
Of another bearish one?
Yeah, another currency pair.
Okay, sure. Let's go to euro. Euro yen's an interesting one. Let's take a look at this one. Or we can do a breakout maybe.
Yeah.
Yeah. Okay. So Let's go to Aussie dollar. This is a potential breakout, not a preferred breakout for me because of the location, but this will be a good example of a bullish breakout pattern here. So again, we want to go through our same process here, IPDE, identify, predict, decide, execute. We want to ask ourselves what price action has done and where price action is currently trading at. And if we take a horizontal line here, I'm starting off on the daily chart again, we'll see that just barely the most recent move here was a break and close above our most recent level of structure. Now, it's important to understand and to note that we do have another level of structure looking left, which is why this wouldn't be an ideal setup for my trading style. But we have a higher high, higher close right here. That would allow me to predict that price is likely to go higher. And then our current daily candle is trading within the upper range of our previous candle, right? So we're trading in this upper range. This is also currently something called an inside bar. Now it's still kind of early in the session, but an inside bar means that this bar is trading completely within the previous bar. We call this the mother bar. And that's typically a sign of some type of consolidation. And we know that consolidations lead to potential breakouts. So once again, I want to go down to my lower time frame, and you can see we get a much clearer picture of what's happening here. We indeed broke and closed and broke out from this previous level of structure. And now we're putting in some consolidative movement where, again, we're looking at price action rallying up and then us stuck in this sideways range. And we call this a high and tight flag formation, which is a pretty powerful breakout scenario. Now, again, want to keep saying this in mind. Ideally, we wouldn't have structure to the left. We'd have clear sailing to the upside. But the market doesn't always give you everything that's perfect. So there's three ways that we can look to enter a potential breakout situation. And you can either stay on the 4-hour chart, you can go down to the lower time frame. There's three ways. It's going to be the before, the during, or the after. So before is going to be essentially anticipating the breakout. I'm going to go and just bracket this level real quick. So you would anticipate the breakout. So we can see that price action has been kind of bouncing back and forth between this range. What you would look for is if price were to come to, I guess it technically doesn't have to, to each his own as a trader, but if price were to bounce back to the lower part of the range, you're looking for a signal kind of like this 3-bar reversal right here to buy and establish your position in anticipation of the breakout, meaning you're looking to buy right here. Stops can be right below this range because, again, if this range is broken, the flag pattern is invalid. The flag pattern is the reason for having interest in the trade, so you know that you can be out. And then what you can do is you can look for the breakout prior to it breaking out. The second one would be the during. So the during would be like more of an aggressive breakout trader where you're anticipating a breakout to the upside here. What you would do is you would put a buy stop right there, write that in, a buy stop right there. That way, as price action is breaking out of this range, you're getting involved in that move higher. The third way would be waiting for a confirmed breakout and a retest. So the third way would be if you break out, you get a confirmed breakout, which gives you more confirmation. Then you look for the pullback back into the top of the range, or at least the midway point of the range. And then you look to buy it as a pullback. So there's pros and cons to all of this. With the before, you're getting the best position. You're getting in all the way at the bottom. You have the chance to capture the absolute greatest range of the breakout. The problem is you have no confirmation that the breakout is actually going to happen. So it's a little bit more dangerous in that aspect. And we'll see that everything is a risk and reward. The next one is the during, which is buying it during the breakout. This gives you a little bit more confirmation because you can see that price is moving in your intended direction. But obviously it gives you kind of a worse entry price because you're getting at a higher level. The pullback is going to give you the most confirmation. This gives you confirmation of the breakout. It also gives you a cheaper price. So it's kind of a combination of 1 and 2. However, you run the risk of this pullback may never happen. If this is a good breakout, we may just go straight up and we may never come back to get this opportunity. So waiting for that confirmation is more conservative in a sense, but it's also more risky because you may not have a chance to get involved in the trade. And that's kind of the balance that we see in trading. You know, aggressive tactics are great because you'll be in every trade. You will not miss any winner, but you also won't miss any loser because you're in it. Conservative trading is great as well because you're going to miss more of those losers because you're waiting for more clues and more proof, but you're also going to miss some of those winners, the ones that move on and never come back. And trading is about understanding yourself. It's about knowing your trading philosophy and kind of deciding, where am I going to fall in that scale? Am I conservative? Am I aggressive? And the truth is, as you develop as a trader, the balance kind of shifts, right? I started on the when I was horrible, I started on the very aggressive side. I was just throwing money everywhere. I didn't know what I was doing. Once I started getting good, I went conservative because I was really, really scared. I didn't want to waste money and blow accounts anymore. And then as I got better, right, as my skill increased, I worked my way along that scale to get more aggressive. Now, I still consider myself a pretty conservative trader, but I'm not all the way on the conservative side. I'm more kind of in the middle right now. So we have those three ways to take advantage of it. And then again, target wise, we want to ask ourselves, okay, where do we think price is likely to go next? We can head back to our daily chart. There's a few ways we can do. Daily chart, we can look at structure. So again, we have a few levels that stand out already. I'll just draw some lines in for us here. We have the top of the current level right there. We have our next level in here. Again, something we can do is bring out our volume and see if there's any spikes. In this scenario, there's not too much. So let's go down to the 4 hour and let's do this. Two things we can do here. We can bring a Fibonacci extension on from this flagpole, so this extended move up. So swing low to swing high right here and back down. That's going to give me a 127 right here at 67.80, a 1618 a little bit higher at 68.45. We can also take a harmonic move, so make an AB equals CD pattern. That's one as well. So that move, copy and paste it. This is the traditional way to look. I don't expect to move this big personally. This is a traditional way to go about it. And then another way is looking at the range of the flag. So if we go down to the hourly real quick, and we just take the range of this movement, I'll make this different color, and then look for an equal range move on the breakout, which will put us right at that 127, which puts us right below that level of structure. So it looks like the 127 extension, 67.80, anywhere between 68 even is a decent place to look for initial targets. And then again, if you want to be more aggressive, you can look for that 1618 or maybe even a little bit higher, right below 169 or 69 cent as being that conservative target. So good example of a breakout trade. Again, ideally for me, I'd like to see it clear of this level of structure, looking left. But the market's not always going to give you the quote unquote ideal scenario.
All right. That's really an in-depth analysis. At this point, I forgot to mention, as we were starting, that this session is actually in partnership with Ingot Africa Limited or Ingot Kenya and Ingot Brokers. So if guys wish to trade, they can use that trading platform. Also, Akil, I know you still have some, as we're gearing to take up some questions, we can use the second link because this one I see will expire in like 10 minutes. But meanwhile, there was a question that had come in from one of the members who wasn't able to attend today's session from our trading community, and they were asking, when it comes to execution and holding time periods, when they're starting out to trade, how do they now, establish their own trading personality? They have tried to see maybe they're intraday traders, but they want to stop the addiction of just being in the markets for the sake of being in the markets, but they want to know how they can be able to execute from a long time horizon all the way to down horizon. So basically just avoiding just being in the markets for the sake of being in the markets, but actually being able to establish their own trading style and personality and how they can go about that. So what would you tell such a trader?
Yeah, I would say first and foremost, you always want to fit your trading style around your lifestyle. So you want to see what you're able and willing to do. Not everyone needs to be a day trader. Not everyone can be a day trader. Not everyone wants to be a day trader. It sounds like a more of a intraday or swing trading approach may be best for this trader, as they want to be involved in the markets, but they don't want to kind of be there every waking minute. And that's how my approach is. If you use a time frame like the 4 hour or the hourly, you think about it like this: you only get a candle every 4 hours. So in a trade like the euro dollar, for example, right, I can do minimum, right? At minimum, it's going to be what, 2.5 hours before the next candle closes. I probably won't get a signal then, but at minimum 2.5 hours. So I really don't have to worry about looking at my charts until that period comes. So you can kind of, if you know the times in your head, obviously keep a track there, or put an alarm in your phone, and do your analysis in the morning. Jot down what you want to look at, and then just come back at those key periods, at those 4 hour intervals. Look, see if anything changed, see if you need to enter anything. If so, you get the job done. If not, then move yourself from the charts again and come back in 4 hours. But if you have a solid routine of pre-market analysis, you pretty much everything you want to do before it happens. And then it just becomes like the waiting game, where you're just waiting to see if the market will give you the opportunity or not.
All right. So at this point, I'm gonna ask, Kish also had some questions. She's one of our co-hosts at STL. She had told me she had a question for Akil. So I think you can ask right now.
Mm-hmm. That's my wife's name, by the way, Kish. Nice name.
Yeah, that's her nickname. Her nickname is Faith, though. I'll call her Kish. Yeah. Yeah, so also, Ultimate, you can also ask a live question to Akil if you have one. Maybe we can also go through like a commodity pair, like USD card, if you have that on your recent trade setups, as we wait for guys to ask questions.
Yeah, this is one that's actually decent setup. This is I'm currently in it's not over yet, in a losing trade right here on Canada. I took a advanced pattern formation, which was a cipher pattern. This was this was annoying when I'll draw it out real quickly for you guys, but it was a harmonic pattern that looked like this. I won't bore you with the details of it, but essentially I entered here. My targets were right here, and you can see the pain that it brought me. It came ever so close to hitting profits, and then just rolled over. And it's looking like it's going to be a losing trade. So this was a very frustrating one for me, because I was in this trade for pretty much about almost 2 weeks, and it just hovered right at that psychological number 136. Never got up to where I needed to go to, and now it's pounding down. But right now we're at a key level of structure. If we look at this level right here, we can see prices come down to a key level of structure. I'll zoom out a little bit so you can get a better read for it. But this is what we call an ice zone, or a structure swap zone, where you can see price action has hit here as support, hit here as support. Previously, it was resistance, support. So multiple times price has hit this level. And now this is going to be another decision point, similar to the euro dollar trade, where the question is going to be, how does price react at this level? We see that momentum is slowing as we come down into this level. Our RSI, relative strength index, is massively oversold. And now we're waiting to see one of two things. Is price action going to hold and give us some type of signal for a reversal, or are we going to bust right through? If we bust right through, then we're looking or asking ourselves, where can we go to the downside? Again, we can bring that volume. We can see structure right here, but if we want some more clues, we can bring that volume on, and we can see that, hey, we're going to have a nice volume spike right down in this level in the middle of consolidation. So that makes for a decent target location, looking for a move from here down to here. Or if we hold this level, right, I would expect that we come back up to our previous level of structure up here. So if we get a signal that we're going to hold, then looking for a move from here back up to about 134.79. So right now it's in the market's hand, and this is one thing I we mentioned before about the 4-hour chart where it's what 6:41 my time, so we have about 2 hours and 20 minutes before the candle closes. There's really no information. There's nothing I can do right now. I know there's not, even one candle later, there's nothing I can use to take the trade. So I know I'm probably about 6 hours away from any type of entry at the closest. So I don't need to necessarily kind of be around my charts the entire time. I just need to jot this down. I've played out the scenarios in my head. If we hold, look for move to here. If we violate, look for move to down there. So now when the close of this candle comes, I come back in 2 hours, check my charts. I see that, oh, we held this level. Now I need X, Y, and Z. Then I'll come back 4 hours later, check that. If we get it, then we can enter. If we don't get it, then we wait another 4 hours or whatnot. But there's a lot of downtime if you're using a time frame like this, where again, you spend the bulk of your time doing your analysis and prepping pre-day or at night whenever you do your prep work. And then it's just waiting. And if you are a rules-based trader and you're treating it like a pro, you're not just guessing for what you need to get into the market. You know exactly what you need, and now it's just waiting for the market to see if it gives it to you. And if it does, you take the trade. If it doesn't, you stay out. So selfishly, I'm hoping it holds, so I can save some money at least and not lose it. But that's part of the game. This is a good reality check of the frustrating part of trading, where you can be up 100 plus pips, and you can't take it early. You can't give into emotions. You gotta let the trade play itself out, and sometimes it will, and it'll reward you with profit. Sometimes the markets will be harsh, and it will turn the other way and take something from you. And regardless of the outcome, you've got to be able to wipe that slate clean and come back and handle the next opportunity like the last one didn't happen.
Have any questions for Akil? So there's a question coming in from one of my person who doesn't want to be on camera, but she's sitting right next to me. So she's asking for beginning traders, now that you use the support and resistance zones, for what's the importance for using less indicators, because you're only using RSI. Less is more in trading. So maybe you can tell people they don't need like a million indicators on their charts, and given your practical experience with what you've showed us, with at least 3 major currency pairs, maybe emphasize on that. Yeah.
Yeah, less is certainly more. I think we all go through that stage as, when we start off, we see all these shiny new toys that we want to play with. And we think, more signals are better. If 1 is great, 2 must be better, 3 must be even better than that. And as we develop as traders, we actually start using less, but understanding more about what we use. And simplicity is key. I think with most traders out there, if you look at most professional traders, they don't use a massive amount of things. They use a small amount, and they're just really good at what they use. So for me, I've gone through the stages of trying out different indicators and different that. I had a time in my life where I had like 18 indicators on a chart and just like did nothing because they never gave me the same signal at once. And I started thinking about what I want my indicator to indicate, what I want it to confirm, and how that relates to my trading. And I chose the one that fits me the best. So for example, I like the stochastics as well, but the stochastics and the RSI essentially give me the same information, slightly different, but the same information. So I don't need 2 on my chart. I chose the one which I thought was more relevant. But yeah, you tend to see that as traders evolve, their charts get a little bit cleaner, and less is more is certainly an approach that many traders use in the market.
All right. And then for macro traders or guys who use fundamental analysis, and also because the macro events do affect price action traders, do you tend to, for some people, especially when they're new in trading, they tend to avoid high impact events like NFP, for example, or when like FOMC is being released. For you, because you've been trading for 18 years now, almost 18 years, and you're giving us your experience in like 40 minutes or an hour at most, what would you tell people in terms of building their confidence and in terms of trading even during those high impact news events?
Well, I would say that, first of all, you don't want to, unless you're very experienced, you don't want to try to trade them with anticipation of what's going to happen. I think a lot of traders get in trouble when they see an NFP happen or an FOMC, an interest rate decision, and like either they try to guess what is going to happen or they try to hop on late. And I think something that a lot of newer traders don't understand, it takes time to, is that the news release isn't really what the market cares about. Whatever the news release is, the number, it's typically priced into the market well before it happens. So we're talking months before. This is the old saying, buy the rumor, sell the news. What the market is looking for is either a deviation from the expectation, meaning everyone thought something was going to happen and then something drastically different happens. And that's when you see those big reactions, or it's anticipating the future. So, for example, we had an interest rate decision here in the US on Wednesday, and the interest rate stayed the same, which should cause no movement in the market. But again, the markets went crazy. So why did that happen? Well, because they talked about what's going to happen in the future. And that's what everyone's trying to hop in right now, because you want to get in before everyone else. That's how you make the money. But I would, especially if you're a lower time frame trader, I would avoid them. You can get caught up in a lot of wacky stuff if you're trying to trade through them. It can be very frustrating because you could do everything right and the market just happens to get emotional for 20 minutes and now you're out of a trade. But I think as you develop as a trader, you're going to start to understand which news events consistently affect the market and which don't, because not every red news event will send the market bonkers, right? There'll be red news events that come out and the market will do crazy. So over time, if you just pay attention to the news and if you journal and track, you can get a pretty good understanding of which news events should affect the market, and you can choose to stay out during those periods, and then which news events don't, and you can trade right through them without worrying about anything crazy happening.
All right. And from your analysis, do you have like a favorite currency pair that you tend to look at more? Do you just focus on the majors and a few minors? Like, what's the combination of your instruments?
So I have a set portfolio that I look at, and I only trade that set portfolio. It is 9 pairs. It is euro dollar. It is pound dollar. It is euro yen. It is pound yen. It is dollar yen. It is dollar Canada, Aussie dollar, and New Zealand dollar, and then Aussie Canada. And I go through that same pair in the same exact order every single day, which is why I can recite it off the top of my head. And those are pairs that have proven to work with my trading style. So when I do my back testing and whatnot, these are pairs that the results have been good. And they're also pairs that, they don't give me too much exposure to a single currency, pairs that don't have a super big spread, pairs just kind of fit everything I want as a trader. As far as favorites, they're all a little bit different. And some of them are very consolidative, which works for my pattern trading. Some of them are very trendy and directional, which works for my trend trading, and others are kind of, they respect support and resistance a lot, which is good for my counter trend trading. So you think about it, it's a portfolio. Although they're all currency pairs, they are diverse because they all bring something different to the table, and that's how I keep a smooth equity curve. As far as which is my favorite, it's whichever is making me the most money at the time. So this year, euro yen has been a great pair for me. It's been a very trendy pair. We've had some massive moves. We're at the kind of the very end of it right now, so it's going to be sad to let it go. But that's my favorite for the year. There have been years where I've hated euro yen. So it's it's pretty much whatever's making me money is my favorite. If you're losing me money, I hate you.
Yeah, we need to make the money. And now that you
Yes.
mentioned back testing, I know especially for people who have been trading for under 5 years, what would you tell them about journaling their trades and historically evaluating their performance to grow and be better every day, 1% every day, so that you at the end of the day, your trading career is what actually sustains you as a full-time professional trader like yourself?
Yeah, I love what you said about 1% better every day. That is my intention in trading. My intention in life is just get a little bit better each day. And if you can consistently do that, you look back and a year ago or 5 years ago, and you're in a completely different place. And In trading, backtesting and journaling is everything. We are in a game where we are playing the probability, meaning we are working with data. And if we don't know our data, how do we know if what we're doing actually works? I've spoken to so many traders who are trading stuff, and I'm like, have you back tested it? Have you journaled? And they're like, no. I'm like, well, how do you know that what you're doing actually makes profit? And it may not. And unfortunately, you see a lot of traders that are trading the right way, but the thing that they're using just isn't a profitable thing. So you need to do that research. It gives you confidence in what you're doing. It tells you that what you're doing works. It allows you to see where the flaws are. Do I need to make tweaks here or there before you get started? And then the journaling is like a continued version of the back testing, because market conditions do change. Everything doesn't work exactly the same way for all eternity. And if you're not journaling, you're not going to, catch on to the things that are lacking or the things that are doing good. And ultimately, you want to do more of the things that work and less of the things that don't work. So it's data acquisition, like any other business, right? The more data you have is the more information you have. The more information you have, the more knowledge you have, and the more knowledge you have, the better decisions that you can make for your business.
All right, cool. Now, before we wind up and tell people how they can get in touch with you and the trial version on your website, I think it's like 2 weeks before joining your chat room. Maybe you can give us like your snapshot or your takeaway for the year for people who want to be technical, purely based price action traders, like the basics of trading from your perspective, and what they need to look for in a price chart, basically.
Yeah, I would say start with the basics. I look at the price chart as being kind of like a never-ending book. And the book gives us a lot of information. It tells us the story that the market is doing. But if we think about back to our school days and when we learned to read, you just don't start off by getting a big old chapter book, right? You start with small books. So you can't read a book if you can't read chapters. You can't read chapters if you can't read paragraphs. You can't read paragraphs if you can't read sentences. You can't read sentences if you can't read words, right? So if you think about a price chart, think about the individual candlestick as being like the word. So understand how to read a candlestick. What is, not just, hey, it's a red one or a green one, a bullish one or a bearish one, but learn about the strength. How do I know if this is a strong candle? How do I know if this is a weak candle? Does this candle, even if it's bearish, is it more of a bullish candle? Even if this one is bullish, is it more of a bearish candle? Learn that stuff first. And once you learn the individual candles, then you can start reading the story of how those individual candles work together. And then once you do that, you can start understanding trends. And then once you start understanding trends, it allows you to grow and just gives you a whole different outlook on the market. So I would say start with the very basics, not necessarily candlestick formations, but just reading an individual candlestick, understanding how to read trends in the market. Once you understand how to read trends, you should be able to see and learn about support and resistance. And I really think once you can understand how to identify support and resistance, supply, demand, like key levels of structure, it becomes very easy to predict where the market is going to go. Not necessarily easy to trade, but with pretty high accuracy, you can say, if we go up, we're going to go here. If we go down, we're going to go there. And, making the right prediction is most of the battle in trading. I mean, like I said, you gotta be able to get in, you gotta have, you gotta, be able to put correct stop losses on and stuff like that. But honestly, most of it is just being in the right direction, and learning how to read a price chart will help you with that massively.
All right, I've got a question that has been typed by Kish. She's asking, have you ever used trailing stops? And if yes, can you show us like on a practical example on a chart? And this is in line with risk management and what sets us apart from gamblers. I get that question a lot. Is it like, trading, how different is it from other betting companies? So just in tune with the theme of today's webinar. And the importance of using stop losses that you have already shown us practically on a chart, but I think it's also best for her to see and other beginners as well.
Yeah, so trading is gambling. All right, it's going to be a hot take saying that, but trading is gambling because we are betting on something and we don't know the outcome. So technically, it is gambling. The difference is we are gambling with the edge. So, you think about the casino is the same way. The casinos are, the owners of the casinos, right? They gamble, right? But the thing is, in the casino always has the edge. So every game that is in a casino, the probabilities of you winning are less than the casino winning. And that's how it consistently makes money. It just has to keep you playing the game. In trading, we are the same way. If we've set up our trading correctly, we are gamblers, but we're gamblers with the probabilities in our favor. So with any given trade, I don't know the outcome. I can't tell you if a trade is going to win. I don't know if a trade is going to lose, but I know that my strategy has an edge. And over time, if I just keep consistently executing it, I will be on the profitable side, consistently executing without like sabotage and error and doing dumb stuff. I'll be on the profitable side. So we are gambling. I think gambling gets a kind of a bad reaction when you hear it, because we associate it with like reckless gamblers, and there's a lot of that in trading. I like to think of traders as being professional gamblers. So we are the casino. We're gambling with the edge in our favor, and risk management is a part of that as well. Now, if I it's saying I'm disabled from sharing the screen.
Oh, let me activate that for you.
But yeah, trailing stops is a great way to lock in profit. So if I can, where's my deal here? So let's take a look at
just
the euro.
In short, Akil, you've just said you're a gambler, but with a strategy and with high probability of making money.
Yes. I'm a gambler with the edge in my favor. Right. But yeah, trailing stops. There's different ways to trail stops. You can use with a trader with the parabolic SAR. You could use as a trail stop. I personally use structure, but I think trailing stops is key, right? As the market is moving in your favor, the idea should be to remove risk and then lock in profit. So let's say we're someone that traded this this kind of breakout here to the upside, right? Our initial stop loss is probably going to be down here somewhere. I'll just use a better line here. Our initial stop loss is probably going to be down here, right? As the market moves in our favor, right, and ebbs and flows up, what we want to do is we want to lock in, we want to reduce our risk and lock in that stop. So let's say that maybe you're a breakout trader right here. When price is moving in your favor, it's proven that we've broken out of this level. There's no need for your stop loss to be all the way down here. So let's move it up, reduce some risk, maybe get it to break even. Now you're trading in a break even scenario where the worst case is that price action moves back and takes you out for break even. And that removes a massive psychological barrier, which allows you to kind of be more confident in your trading. And as we continue to ebb and flow up and create these new levels of structure, right? These levels of structure create levels that I know shouldn't be broken, right? If I'm right, we should not pull back past this level, so I can move my stop up to here. And then what you're doing is, hopefully you took profit by here because we're at structure. But let's say you're someone that didn't take profit and the market starts making its way back down. Yeah, you lost some money, right? But you never hit your initial stop. You didn't take a loss. You didn't lose money. Technically, there was money that you could have had that you lost, but you still made an earning right here, even though your trade didn't technically play out the way you thought it would be. So risk management is key. I think trailing stops is key. You just have to be smart about it. You do it too soon, you're going to cost yourself some money. You do it too late, you're going to leave yourself open to risk. So you have to be smart with it. And like anything else, it should be rules-based, not emotionally based.
All right. And then another common question that I also get a lot is, how many pips do you target in a day? And this is also related to people who ask in terms of not manually trading, but maybe they want to use signals provided by people, or they want to copy trade. So they normally ask based on how much they would be expecting to make, for example, then now they work backwards. How many pips do they need to target every day? So do you, especially when you're training your students, how do you answer that question?
So I have zero expectations. I don't have any pip goals, any pip target goals for day, for month, week, whatever it may be. My job is to take what the market gives me. And there are going to be days where the market offers a lot and it gives me a lot. There are going to be days where the market takes some from me. There are going to be days where just no signals happen and nothing occurs. So I've never been one to have a pip goal. I think you can get into some trouble doing that because, we have goals so we can try to achieve them. And if the market is giving you nothing and you're not hitting your quote unquote goal, you start to feel like you're underperforming. You start to feel like a loser because I'm supposed to get 50 pips today, but I didn't get it. I must be doing something wrong. And the reality is you're doing something right. The market just never gave you the opportunity to get those 50 pips. But because you felt like you did something wrong, now all of a sudden you're doing stuff out of your plan to try to achieve that goal. So you're taking signals you're not supposed to take, or you're heading to other pairs or asset classes that you're not supposed to be in, all because you're chasing this goal, because that goal is supposed to tell you that you're doing a good job. So, my philosophy is you take what the market gives you. You don't have any pip goals for the day. If the market gives you 100 pips in a day, it gives you 100 pips. If it gives you 200, it gives you 200. If it gives you 0, it gives you 0. Your job is to execute good trades at a high percentage. So, don't make mistakes. Take what the market gives you and don't do anything different than that.
All right. So I think that's it for today. You can tell people, you can plug in all your website, people can get in touch with you. And also for us, we truly thank you for being on our launch 2 times this year. Maybe next time you can talk to Jason, and also we would love to host him as well on
Nice.
Trading Lounge. Yeah.
Sure. Yeah. A few places you can catch me. I'm all over social media, just at Akil Stokes RTM. I also have a podcast called the Trading Coach Podcast. Comes out 3 times a week, sharing all types of awesome information. Then, as you mentioned earlier, I'm a trading coach and mentor over at Tier 1 Trading. So you can head over to www.tier1trading.com. We have a 14-day trial membership. You can get on the platform, take some courses, hop in some live sessions for 14 days. It's risk-free, so there's no auto bill or anything like that. Once your 14 days are up, you're simply kicked out. So I know some people do kind of the sleazy stuff where you get a bill in the mail if you forget to cancel. We're not doing any of that stuff. You just lose your login. So www.tier1trading.com. And also, like I said, check out the Trading Coach Podcast. There's like 900 episodes, lots of cool content, and 3 new episodes each week for you.
Yeah, I second that because I see your posts every day, the shorts. Yeah, and good job. Good job.
Thank you.
So for that, I think, guys, it's a wrap. Trade with Ingot Africa Limited. And Akil, we'll see you next year. Happy festive period with your family. And cheers. To apply the lessons learned from Akil Stokes, you can use Ingot Africa Limited trading platform. You will be able to see all the major pairs that we've discussed and all the 9 instruments discussed by Akil Stokes. And happy holidays.